So in just talking about psychology of where we're at now, you are seeing people exiting stocks because they've come back down. And you know, this is a good example. This is Silver Chef, which if any of you've had money in our unlisted fund, we bought the shares at $1 and we ended up selling them at $9 5 or 6 years later. It was a very good experience for us. And this is the chart of one of the hiccups that Silver Chef had. So if you treat yourself like you own Silver Chef, so Silver Chef's a business that does financing for restaurants. So all of the silver equipment out the back, the fridges, the ovens, the cooktops, they finance all of that. It's asset backed because they can go and sell all that equipment. There's a very active second-hand market for stainless steel equipment. It can be re-welded and put into other kitchens. So there's a good market for it. What happened in this case here, you'd seen a lot of people selling that stock off. It had a profit downgrade. But if you owned that business, it wasn't really a profit downgrade. And unfortunately, the way a lot of equity analysts work is if a number doesn't come in by 30 June, that business is not worth as much as what they thought it was. So if it comes in on the 1st of July, you can't put it in your results, and these guys are going to sell off that business, which is one of the most ludicrous things, because if we all owned that business and the contract comes in a week or a month later, you don't care, you got the contract, you got the business. But the equity market, a lot of analysts don't treat it like that way. And it's only the incremental seller. Look, there'll be a whole heap of people who like this business that don't sell it. You know, like the founder didn't sell the business, he had a big shareholding in it. So in this case, we actually topped up our position. So you can see here, down the bottom, we doubled our position in that, and you can see 12 months later, there was nothing wrong with the business. So that sort of gets back to, you know, the question over here, how long can it take? As long as it takes for the market to realise that there was nothing wrong with the business before. And, you know, we hear some crazy stuff about businesses. A couple of weeks ago, Caterpillar, you know, the people that make the big earth-moving trucks in the US, their result came out. I spent a lot of time looking at international markets. And they announced that they had a $17 billion backlog in terms of orders. It's huge. So I think straight away, great, we own a position in Emeco. Emeco's got a fleet here. There's a 12-month wait list to get fleet in Australia on that heavy earth-moving equipment. And we know that because we've talked to people who are trying to buy the fleet. So I think this is great. Emeco can put up their prices because no one else can get their equipment. Stock got sold off in line with Caterpillar in the US. And it was crazy. And Caterpillar only got sold off because they can't meet the demand. So the growth's not as big as what it used to be. So you have to really look at what's happening with your business. And now if I owned Emeco outright and it wasn't listed, I'd be saying this is the best market conditions I can have. None of my suppliers can supply me with equipment, but they can't supply my competitors either, and I've got a rental fleet. So all of these resource projects that want to, you know, increase their capacity and output, and new mines are opening, they have to rent off someone like Emeco, and Emeco's bought their two largest competitors.